Good evening, everyone. So today, I'd like to introduce a good friend of mine. His name's Jordan Eliseo. Jordan is the chief economist of ABC Bullion right now, which is the largest private bullion dealer in Australia. And he's been investing in gold for the past decade. He's been a guest on various shows, like the Today Show, CNBC Asia, and quite regularly on Sky Business now. Today he'll be talking about a few things, such as his past investment experience, his own lessons learned, his views on the true state of the global economy, the true state, current valuations in financial markets, and why he believes that gold is still a very good investment despite the past few years. So I'd like to introduce him now. Yeah, thank you.
Thanks a lot, Michael, and to everybody here, thanks a lot for giving up a bit of your time this evening. Really honoured to be invited back actually to speak to UNIT. Came out here last year and really enjoyed my time and a lot of the questions. Actually remember one of the guys asking me a question on gold specifically that made me go away and write quite a detailed research report in response to that question. So really enjoyed my time last year, and I hope that if anything, over the next hour or so with some of the stuff that I'm going to talk about, I can hopefully just pass on a few experiences from my own career and sort of things that worked, things that didn't work. Sort of special mention on a couple of the mistakes along the way, because I think we all learn more from our mistakes than we do from our more obvious successes. With the ultimate aim that if I can leave you guys with a few things to think about as you sort of move forward with your studies and your work and professional lives, and maybe a couple of tips on how to get ahead financially, then it'll be a job well done and some time well spent. So I guess the topics that I'm going to talk about, as Michael discussed, just a little bit about how I got into markets, and as I say, a couple of stories on the mistakes and highlights. I want to just talk a little bit about the state of global asset markets today, looking at the actual breakdown of the global financial asset pool. It's not something that most economists or investors ever look at in terms of where actually money sits in investment markets today, and I think it's a really interesting way of starting your investment portfolio, or your way of thinking about markets is asking what the breakdown of equity, bond, fixed income markets and the like is. Spend a bit of time talking on what I see as the three mega trends that are affecting the global economy. They have been for some time and will do for the foreseeable future. And they're very simply the levels of debt in the world, the role of the ageing population, and the nature of big government itself today. And finish off with, ultimately a little bit about why I'm so honoured and thrilled to work for ABC Bullion, who's the largest private bullion company in the country. I obviously still see huge upside potential in gold and physical precious metals in the coming years, so that's why I decided to make the move into that space out of more traditional asset management. And a last one with just a little bit of a talk on the importance of superannuation. It's obviously a subject that's in the media or the financial media all the time. It's not something that I can imagine you guys have probably given a lot of thought to now, considering your age, and most of you are obviously still at university, or all of you are, but particularly for you guys, seeing as you're going to be putting in 10% plus for your entire working lives, I can tell you that most Australians don't save anywhere near that much money outside of super. So it is going to be by far the largest financial asset, specifically that your generation, or we're actually all part of the same generation, but that you guys are going to build. So I just want to talk a little bit about the importance of that as well. Can you guys hear me fine up the back, by the way, before I keep going? Yeah. Okay, great, no problems. So first thing that I want to talk about, or the first mistake I want to talk about, and ironically, considering I work for a gold company, is a company called Takoradi Gold. And no dispersions on the company itself or the management. It actually still exists as a company today, but this was probably one of the greatest lessons that I learned about investing. I was still in university when the NASDAQ bubble basically really took off in the late 1990s. I had a job working for BT, who will come up in one of the next stories, and I moved out of that to go and work for a discount brokerage company called TD Waterhouse at the time. And at the time, TD Waterhouse, I think Commonwealth Bank had just launched CommSec and their sort of online trading facility. E-Trade launched, you name it. There was all of these online platforms that basically made share trading far more accessible to the everyday public than what it was previously. You know, before that, you needed to know a broker, you had to pay a large commission to get in and out of shares. People tended to stick to sort of ASX top 100 companies and the like, and it was a far sort of more stable probably system in a lot of ways. The sort of online trading revolution really changed that, and basically a lot of people got hooked into this online trading, and obviously everyone started buying tech stocks. There was a story that really this was a new paradigm. The Nasdaq bubble would never ever burst, and prices would constantly go higher. Warren Buffett was famously chastised back then because he refused to invest in the sector. He said he didn't understand the valuations, didn't think that the businesses were worth what people were paying for them, and didn't basically trust the business models. And for many years, while the bubble was growing, he was sort of mocked and considered to be a bit of a relic and a bit of a dinosaur because he wasn't getting with the program. Of course, his track record is still standing in a much more impressive fashion than the Nasdaq itself 13 years on. So Takarati for me was basically my personal experience with buying a company that I absolutely had no idea about. And I can remember that it was trading at 3 or 4 cents a share. My brother and I actually borrowed a few $1,000s from the bank. We bought it amongst a few other shares. It went to about 10 cents. At that point, because I was working for this brokerage company, we had clients coming in through our front door every day and on the phone, and I was 20 at the time. I had no idea about the market, but they would ask me, Jordan, what's your stock tip? What do you think is the next great company? And this company, as I say, it was called Takarati Gold, but there was a rumour, just a rumour, no business model, no announcement, no profits, no sales, no nothing. There was a rumour that they were getting into some kind of voice-over internet program, and that was enough to send the stock quadrupling in price. And Hot Copper and other forums and the like were saying that this stock was going to go to $1 a share, all the way from 3 cents. So someone like myself, who'd done all of 2 minutes research but was completely believing in the hype at the time, was like, well, I'm going to buy this stock and ride it the whole way to $1. Of course, it crashed and went all the way back to about 2 cents. And I remember more than, if nothing else, I remember someone actually writing on the Hot Copper forum that considering the amount of stock that they had issued, had this stock gone to $1, it would have had a market capitalisation bigger than Telstra. So the lesson from that, and it wasn't just for someone like me as a 20-year-old, because I can tell you we had lawyers, barristers, business owners, you name it, coming in and pouring serious portions of their wealth into this sector, not necessarily into this stock, is that don't invest money, or certainly don't invest a lot of money, unless you really understand what you're investing in, or you know personally and trust implicitly the people you're doing business with. It was a fantastic lesson for me because I learned it when I was young, and I learned it when I didn't have much money to lose. So whilst at the time losing a couple of grand was a real big deal for me, in the context of a sort of 50-year working life, it doesn't mean a whole hell of a lot, and it was just a great learning experience. You compare that to people who got burnt with investments like this, and they were 50 or 60 at the time, and they built up a lifetime of savings, it hurt them a whole hell of a lot more. And that's why the GFC was so painful, particularly for older Australians, because they were coming to the end of their work days. They lost a big portion of their money at a time where they didn't want to work for a whole hell of a lot more. So that was a major lesson for me. And just in terms of understanding how crazy that entire market, not just that particular stock was, this chart actually shows what happened to the Nasdaq from 1995, when you can see it went from about 600 points all the way up to just about 5,000 points. So it went up nearly by a factor of 10 over a few years. It was probably overvalued by the time it had got to 1,500, 2,000 points, but it still went all the way to sort of 5,000 before finally crashing. And that's the other thing that's really important to remember when it comes to looking at investment markets. There's a very famous comment that the markets can stay irrational far longer than you can stay solvent. I think I've quoted that correctly. And the point being that you can look at a market and go, it doesn't represent good value anymore. It could still easily double or triple before the sort of eventual crash or the eventual correction comes. So if you have the courage of your convictions, and if you know how to understand value, then there are times where you actually have to just be patient for a long time. Because as I say, guys like Buffett that weren't buying it here were looking like absolute fools here, but looking like geniuses when we were back down here. So that's a really important thing to keep in mind. And actually, just as a final lesson on the NASDAQ, be very careful about listening to the so-called investment professionals as well, because after moving from TD Waterhouse, I came up to Sydney and worked for BT again, or I went back to working for BT, and they actually launched, I don't know the exact date, but it was basically around about, I think about May of 2000, what was called at the time the BT Time Fund, which stood for something like technology, info, media and entertainment. So it was basically a specific managed fund set up for retail investors to put money into which would invest in this sector. They launched it almost exactly at the top of the NASDAQ bubble, because you can see what happened basically within the space of about 2 years. It lost well over 50% of its value. And even today, I took this was from the end of this year, 31st of the 12th, 2013, and you can see that since inception, the returns are basically minus 5% across 13 years. Now think about how much technology has changed and grown in the last 13 years and how amazing it's been. I can tell you guys, when I was your age and at uni, I didn't even have a mobile phone, right? When we first got them, they were about this big, right? When I was actually in year 12, the internet was something we were still reading about, but it was being developed. I remember it being referred to as this information superhighway. Does anyone remember that term? Everyone my age remembers that term, because that's what we used to call it. And I actually remember asking a mate of mine who was an engineer, and I'm not too embarrassed to say this, where is this new highway they're building? Right? That's a genuine truth. We learned to type on these old sort of Commodores with the green screens, and so that's how much technology has changed amazingly in the last 13 years. Yet a professionally managed fund, which has been investing in that sector for the last 13 years, for that entire duration, has actually lost 5% annualised over that time. So that's a really important thing to keep in mind. Just because the sector's growing, just because there's amazing change occurring in that sector, doesn't mean there's necessarily going to be fantastic returns on offer just by being an investor in that sector. You've got to know when to get into the market, and if you're buying good companies at good value. As I say, companies like Amazon and all that kind of thing, amazing businesses in many ways, doesn't mean it's a great investment if it's trading at a crazy multiple of its valuation. And it's really relevant to keep that in mind, because this is a screenshot from Bloomberg just earlier this year. I'm not sure if any of you guys know. How many people use Twitter here? Decent number. Twitter share price dropped 18% today. This is the valuations for LinkedIn, Amazon and Netflix taken about, this image is probably a couple of months old. So LinkedIn is trading at 718 times reported earnings right now. It's absolute, look, good luck if you make money in it, but you are really taking a lot of risk. I'm not saying it's a bad company, it's an amazing company, I use LinkedIn every day, but the valuations that people are paying for these stocks, there's a lot of people that think we're basically back in the NASDAQ bubble round 2. I'm not sort of necessarily saying I agree with that, but certainly when you see numbers like that, you sort of think, geez, I'd want to be pretty careful before putting my capital to work in an environment like that or in a company like that. A brief one, I guess, just on the highlights. Those, as I say, those mistakes were things that were really, really valuable to me because I learnt lessons and it didn't cost me too much capital to do it. What it did do, and it's why I'm in the precious metal space now, was kind of lead me, I guess, on a bit of a road to find out, well, why did companies like BT launch those funds? Why did the market crash like it did? Why didn't it keep going when the front pages of the finance news and even mainstream news were saying that this was a new paradigm? And that ultimately led me to, I guess, get a bit of an understanding of what we now know as the GFC and the global debt bubble that we were in. And so back in August of 2004, myself and basically my best friend Ben, we set up a company called Argentaurus Capital, which was basically, and still is today, a precious metal related fund just for ourselves and a couple of our friends and family members that kicked in some money. And the whole genesis of that investment portfolio was to start buying physical gold, physical silver, and shares of some of the mining companies and the like. Back then, gold and silver prices, I think gold was about $300 or $400 an ounce. Silver was about $5 an ounce, and gold and silver stocks were, even despite the correction they had last year, were much cheaper back then. So it was a way for us of being able to start to put some capital to work for the long term in a sector we felt we understood and where we thought there was absolutely no love towards that sector at the time therefore valuations were likely to be cheap and we could make some decent returns. So still very, very happy to run that portfolio now. It takes up very little amount of my time, but you know, having that was a real highlight to be able to start that and start putting some capital to work there. And that, I guess, ultimately leads on, as I said, you know, the reason we set it up was because of a bit of an understanding of the global debt crisis, and that basically leads on to, I guess, these macro challenges, these three macro challenges that I want to talk about tonight. Apologies for those of you who were here last year, because it's sort of some of the same ground. I'll do this part pretty quickly, but as the heading of the slide says, look, guys, the GFC was a simple enough story. A lot of people will say it was a lack of regulation on Wall Street. They'll say there was greed on Wall Street, investment banks and the like, people that were taking out loans that they were never going to be able to pay back. And look, all of those things are true, but all of those things were really just the straw that broke the camel's back. The reason the GFC occurred, in really simple terms, is that as a society, we've just borrowed too much money for too long, gone too far into debt, and the GFC was basically the beginning of the end of that cycle. Now, debt is, in and of itself, is not a bad thing. You ask any successful business person in the world, and they will probably have used debt at various times in the operations of their business to fund their balance sheet, to operate as efficiently as they can. But the key is the money that you're borrowing needs to be invested in a way that can produce enough income to justify borrowing the money in the first place, i.e., it should show up somewhere in GDP because you're actually producing something as well as borrowing, I should say. So when we look at a chart like this, which shows the aggregate amount of debt in society, and this is using the US as a proxy, relative to the amount of GDP we're producing, we can basically measure the size of the imbalance between what we're borrowing and what we're actually managing to produce in any given year. And this chart goes all the way back to 1900, and you can see there have basically just been two periods in the last 115 years where, as a society, all levels of society, individuals, businesses and government, have borrowed too much relative to what we're actually able to produce. And the first of those is the 1920s and the early 1930s. Everyone, I'm sure even you guys have read about it in your studies. The Great Depression, stock prices fell 80%, unemployment went to about 25% as well. Really, really difficult period for people. It wasn't the end of the world, but a really, really difficult time for people, and a time particularly for investors and those of us with money. The main thing that people should have been focused on was preserving what they've got rather than trying to maximise returns, because those people that were merely able to stand still from an investment perspective during the Great Depression did far, far better and kept their capital intact for when it was a good time to step back into markets. And the second period that we're living in is the one, guys, that we're all living in today still, and which first started causing us problems when the GFC struck 5 years ago. And as you can see, we've pretty much been building towards it uninterrupted since the 1970s. So since the 1970s, for most people around the developed world, real incomes haven't really improved in any meaningful way. What's allowed us to increase consumption, what's allowed us to build bigger houses, drive nicer cars, wear fancier clothes, you name it, is that we've simply borrowed and gone into debt, and that money is not only going to need to be repaid, or at the very least, it needs to be serviced with interest going forward. And that's basically why the GFC, when it hit, caused such disruption, because individuals basically stopped going into debt to fund their lifestyles. And what you can see when you look at the chart, you can see that aggregate debt has eased slightly in the last 5 years. But what that's been a function of is a function of the private sector. So this is businesses and individuals saying, no more, I don't want to go into debt any further. I've borrowed enough, I'm going to live within my means, I'm just going to use my income to fund my lifestyle. On the flip side, you've had governments spending money at the fastest rate in history. Government debt across the entire developed world, on average, has been growing by about 5% of GDP every single year for the last 5 years. So you've had the private sector not really pay anything back, but start to live within its means at the very least. You've had government live outside and beyond its means at the fastest rate in history. And I'll put a bit of context around that later with a chart, again, I did show last year. The second major trend that's going to affect us over the next sort of 10, 15, 20 years, which was not a factor during the Great Depression, which makes things worse this time, is the nature of the ageing population and the number of people we actually have working relative to the number of people we have in retirement taking social security benefits via the government. So back in the 1950s, and again this is using the United States as a proxy, there was basically 16 workers for every one retiree. Today, there's only 3.3, or in 2005 there was, and in the future, it's trending down that there'll only be 2 workers for every retiree. This is particularly relevant for you guys because you guys are just about to enter the workforce. In a nutshell, you're basically going to have to prop up your parents and your grandparents because there's going to be less and less of you working for more and more of them who are retiring and living longer and wanting to take, well, being allowed to take pension payments and you name it out of the system because of the nature of the way that our society is structured. And to give a sense of the scale of how significant this is going to be, the fact that we're going to have less workers going forward than what we've had previously, in a relative sense, means that the actual rates of growth that we're going to be able to generate are going to be much lower. So McKinsey Global did a report on this a few years ago, and they basically estimated that between 2010 and 2024, global growth would be impacted to the tune of some $20 trillion, less than what we would otherwise be able to produce if the population wasn't ageing. That's a real problem that's compounded by the fact that spending is going to explode. So again, this actually comes from the Government Accountability Office in the United States, and this was their projection over a quarter of a century, 2007 to 2032. They projected that GDP, the economy itself, would grow by about 71%, but the amount of money the US government was going to have to spend on Social Security, Medicaid and Medicare was going to grow at between 2 and 3 times the pace of the overall economy. And these are not small ticket items on the US government's annual P&L statement, for want of a better word. This is not you just cutting out your morning coffee at the coffee shop. This is like your mortgage payment, right? These things, Social Security, Medicaid and Medicare, alongside other what they call non-discretionary spending items, already account for more than 100% of US tax revenue. What that means is if they basically close down every school, bring back every soldier from around the world, don't spend a cent on infrastructure, funding science and research, you name it, they will still run a deficit next year because these things will consume more than every tax dollar that they're taking in, and they are going to grow at between 2 and 3 times the rate of the overall economy. It is a very, very serious problem that no government around the world is showing even the slightest hint of wanting to deal with, because it is political suicide to try and take benefits from people that have been promised it. And it gets even harder as the population is ageing, because democracy is nothing but essentially a popularity contest. So if you're trying to get elected, who do you want to appeal to? You want to appeal to the biggest voter base, and the voter base is increasingly ageing. Therefore, the last thing they're going to vote for are cuts to Social Security, cuts to Medicare, cuts to Medicaid. And that's why I'm sure some of you guys have seen, the budget's coming out in a couple of weeks in Australia. What's being proposed? Cuts to student funding, cuts to people on the dole and who aren't working at a younger age. They're not going to cut negative gearing. They're not going to cut superannuation concessions. They're not going to do much to pare back the age pension, because that's where all the votes are. That's where the power is. You don't want to upset those people. Younger people who are less enfranchised and less engaged in the political system, and who there's less of and have less power as a voting bloc, those are the people that they'll cut benefits from. That's just the nature of the system itself. Doesn't mean they're bad people, but that's basically the problem with essentially allowing government to take too much control of our economy. And that pretty much leads to this third issue, which I'll talk about in a little bit more detail than I did last year, which is the nature of government itself and the danger that big government poses to essentially our overall prosperity. Government is not a bad thing. I don't buy into that. So I know there'll be some people in the room that'll disagree with me on that, but I don't buy into that per se. The key is that you need to control the size of it and make sure it focuses only on the things that perhaps we can't do for ourselves, or perhaps where we want to ensure there's a social safety net. This is a real problem. This is the total remuneration on average for private sector employees versus federal civilian employees from 2000 to 2009 in the United States. The Cato Institute do some fantastic research. And what it shows is that back in 2000, private sector employees were earning 45 grand. That grew to 61,000 over the next 9 years. This is not inflation adjusted. Whereas public sector employees went from 76,000 to 123,000. Guys, you need the best and brightest and most well-paid people working in the private sector, because the private sector is actually where profits are generated, and that, if you want to have a sustainable government, is what the government needs to be able to take some taxes from to fund social welfare programming. It doesn't work when the best and brightest people are going to naturally be attracted to go and work for government itself, because they can earn twice the salary, work half as hard, and have 2 times as much job security as well. So the fact that we're in a situation now where it's so much more rewarding to go and work for government is a really, really bad thing for society. Not that it's not a bad thing to work for the government. That's not what I'm trying to say here. What I'm trying to say though is that it's a much, much more preferable situation when there, on average, are higher wages in the private sector, because we want our best and brightest. We want you guys, for example, to go and work as engineers, to go and work in finance, to help design new technologies and that. We don't want you guys on the more, like, what we would call redistributive side of the equation, which is ultimately what government is there to do, take some money from one group of people and spend it on another. So that's one major change that's occurred that is most certainly not beneficial for society. Second one is just the number of subsidy programs we have now. You know, if you listen to a more mainstream economist, or you know, as I say again, even just listen to a government official talk, they'll talk about the period between 1970 or 1980 and sort of the GFC as this period of untold prosperity in society, where markets never did better, where people's standards of living never rose more, where the private sector flourished like never before. Well, if that's the case, why did the number of subsidy programs that government needed to bring in to prop up businesses basically more than double over that time? Doesn't make any sense. If everything was going so well, why did we need to give... subsidy programs are basically bailouts for big business, right? Or bailouts for business in total. The fact that we've got so many more what you'd call nominally private sector employees working for companies that only exist or perhaps exist to a large extent because of the fact that they get a handout or a bailout or a subsidy from government is, again, a major problem that we're going to have to deal with in the coming years. You know, for example, in Australia, we've talked a lot about manufacturing in the last few years in our car industry. And the car industry is basically going, well, you're not giving us any more subsidies, we're closing down. That's the nature of things now. So many companies that are nominally private sector can only actually survive if they're given a handout from the government, i.e. if they're given a handout from our taxes. Second one, or another factor, is literally, as it says here, complying with Uncle Sam. This is, again, using the US as an example, and that's the United States tax code. So imagine this, back in 1913 or even 1939, you want to open a new business, you basically open a shop and you get going. The tax code's a few pages, it's pretty simple, no need for an expensive accountant, no need for a huge amount of time to be spent going through rules and regulations just to try and comply and not break any rules. But as we've gone forward over the last 50 or 60 years, the amount of rules and regulations that we've put in place has just gotten larger and larger and larger. And that really, that impacts the private sector enormously, especially small businesses. Big businesses can deal with it because they've got their own legal teams, they've got their own accounting teams, they can afford consultants to come in, they can actually lobby government on policy, you name it. But the small businessman who might employ one person, might even just work for themselves, they don't really have the time to basically comply with thousands and thousands of pages of tax code and other kinds of legislation and red tape that they've got to be aware of. So again, this is another trend that fits under this banner of big government that makes things even more difficult or makes the challenges that we face today even more difficult than what we did when the Great Depression hit. And look, ultimately, the easiest way to sum it up is by looking at the amount of money the government actually spends as a percentage of GDP and compare it to where we were in the 1920s when the GFC, or when the Great Depression hit. And you can see here, with the exception of obviously the First World War and then the Second World War, government spending is basically back to, you know, when you add in the state and federal spending together, pretty much close to 50 cents in every dollar is in some way impacted by government. So when we talk about living in free markets, I'm not quite sure what these people are talking about. If 50 cents out of every dollar is actually not ours to choose from, it's not ours to spend ourselves, that's not a free market, guys. And in parts of Western Europe, this number is even higher. My biggest concern, though, is the fact that, as it stands right now, this is actually unlikely to stop for the foreseeable future, which is why as individuals, we've got to be so cautious about the way we approach things going forward, or until some kind of market event occurs that forces change on the system. This next chart, that's why I call it paying for your parents' sins, goes to show that all of that government spending that I'm talking about, it would be bad enough if it had been paid for in taxation, right? If they'd actually taken money off of everyone to fund that, that would have been one thing. But the biggest problem is that governments have not actually taken the taxes to fund all these expensive social welfare programs, and that's why government debts in so many countries are around 100% of GDP or higher. In Japan, it's over 200%. But even that, the very fact that we talk about government debt as a percentage of GDP, and I'm guilty of it myself, to me is a real problem, because the government does not own all the GDP of the nation. We own it. You guys own it. When you go and work and you're creating wealth and building a business or working for an employee, that GDP is yours. You pay a percentage of it in tax, yes. But when the government talks about debt to GDP, they're responsible for racking up all the debt. They do not own all of the economy. So the correct way to look, in my opinion anyway, at the true state of government finances in any given year is looking at the percentage of the difference between what they spend and what they take in tax revenue in any given year. Because that's the deficit, really, right? It's not 1% of GDP, it's the difference between taxes and spending. And when you look at it this way, it really starts to get pretty alarming. And this goes all the way back to the 1960s. So we're basically talking about the Kennedy administration as well as the election of Richard Nixon. And basically what this shows is every single year, as it says there, the annual deficit as a percentage of tax revenue. And you can see that during the 1960s, didn't matter whether it was blue basically means Democrat and red means Republican. It doesn't matter, Democrat or Republican, they all ran deficits every single year. As I say, by the late 60s, Nixon gets elected, takes the US off the gold standard. There's actually a slight surplus one year, but mostly deficits again. Then I think Jimmy Carter gets elected. He's only in office for 4 years. Huge deficits every single year. And then Reagan comes in, followed by George Bush Sr. Now, Republicans love telling in America, they love saying that it's the Democrats that are the big tax and spenders, and that the Republicans believe in conservative fiscal management, and that they're the adults in the shop. Kind of not too different to the way Labor and Liberal talk in Australia here, or the way the Liberals criticise the Labor Party here. But have a look at what Reagan and George Bush Sr. got up to. They ran the biggest deficits in history at the time, every single year that they were in office. Dick Cheney famously said that Reagan proved that deficits don't matter. He also shot his best mate when he was hunting, so you know. Anyhow, we come to the end of 12 years of a Republican administration. Bill Clinton is busy with winning an election, amongst other things, and he sort of presides over that period of the NASDAQ bubble, and corporate tax receipts are at all-time highs. Things, you know, that's kind of the peak of the sort of American, I guess, post-Cold War experience. Actually manages to run a couple of surpluses. Then George Bush Jr. gets in, the Iraq War, 9/11, you name it, hits, and we basically see that happen. So as I say, a couple of surpluses under Clinton, we'll give him some credit there, and George Bush gets elected. And I forgot to print the exact words off, but anyway, obviously the GFC hits. Americans are pretty fed up and they vote for change. And there's a man that promises it to them. And he says that the GFC is a result of the last 8 years of waste under the Bush administration. And he promises, before getting elected to office, that he will cut the deficit in half in his first term. You guys all know who I'm talking about. Fantastic speech, probably the most eloquent orator since Cicero, but in reality, this is what he did. So guys, the beauty of coming and talking to guys like to a group like yourself is that you can see this and go, this is ridiculous, right? Like this is not a sustainable way of running a nation. This is not you couldn't run a business like this. You couldn't run your own personal finances like this. You haven't been out in the workforce for 20 years, so you haven't bought into this system and gone, oh no, everything will be okay. When I look at that, I go, it's not going to be okay because I believe in mathematics. 1 + 1 = 2 every time. You spend more money than you earn for as long as eventually you will go bankrupt. It's as simple as that. And that is why that red line at the bottom is the US money supply. That's why that's had to go through the roof over the last 5 years, because the only way to keep the system going right now is by continuing to print money. That's the only way to do it. And governments around the world have absolutely no plan of stopping. This chart comes from the Congressional Budget Office's latest report produced in September of last year. And that red line, or the green line, the one at the top, represents the amount of money as a percentage of GDP. We're going back to the way the government likes to talk about it. The percentage of GDP that the government plans on spending. The line below it is the amount that they plan on bringing in revenue every year. Now, it's pretty obvious what the problem is, guys. The two don't ever touch, let alone go in the opposite direction. So they are planning, as it stands right now, to go into debt every single year into the future, further and further and further into debt. That chart goes to 2038. They actually have one that goes to 2088. And I've got bad news for you, the lines still don't touch. So this is the system that we're all trying to operate under. And the really, really sad thing about it is that it's not working, because the whole point of all this extra government is that it's meant to make society fairer. That's US income inequality going back to 1947. Look what's happened since 1971, when we went on this absolute credit binge that we've been basically doing for the last 40 years. The gap between the haves and the have-nots has never been higher. This is the average household income. Again, this goes back to 1970. Look what's happened. The bottom 20% have gone nowhere. Fourth, third, second, pretty much the same thing. The top 20% have done okay. The top 5% of society have done absolutely brilliantly out of this huge credit bubble and out of this huge concentration of more government, of us having less freedom to choose for ourselves, and more and more control being vested through the power of the government. In fact, since the GFC hit and interest rates were cut to zero and money's been printed like we've never seen before all around the world, there have been studies which are suggesting that over 90% of the wealth that has been created in the last 5 years has gone just to the top 1% of society, the top 1% of most wealthy people. So if all of these things are being done to supposedly create a fairer world, why has the world never been less fair? It doesn't make any sense at all. But the powers that be are benefit incredibly from the system, and they're not going to change it in any meaningful way until the market forces them to. Just one last thing I want to talk about when it comes to, I guess, the economy, the nature of the economy itself, and some of the things that I think are quite silly when more mainstream economists talk, and some of the things that they focus on. And it's actually just the nature of gross domestic product itself. Everyone's seen this slide, right? C plus I plus G plus X minus M. All it measures, guys, is spending. It doesn't measure anything to do with prosperity. So, as I say, start a war, build some cruise missiles, that'll boost GDP. Have a natural disaster. There were actually people, there were economists, when the tsunami hit in Japan a few years ago, that actually wrote it was a good thing because it would boost Japanese GDP, because they would have to rebuild bridges. That's not a joke. So if you want to go and speak, I don't know if any of you guys are doing economics class or whatever, but just maybe, I'm happy to send this to you guys. Show that slide to your professor and ask them how many times he or she goes home at night and deliberately crashes their car and smashes their own window, because if they did, they would boost GDP, right? It's a really, really stupid thing to do though. Car accidents, you name it. But if we actually break down the components of it, if you look at consumption, it's a good thing that we can consume. I bought a coffee just before I came to speak here. Today I'll get a cab home later. Nothing wrong with that. Really good. Main thing though, it's good if you pay it out of income, not debt though. You don't want to use a credit card to pay for your discretionary spending items as a general rule, because you're basically buying things you can't afford. If you're going to put things on debt, you put your investments on debt. You invest in a business. you use debt for that, that's okay. If you're buying a house, provided you're conservatively leveraged, again, maybe not such a big problem as well. Investment, this is the big one. You know, I'm sure, again, when you guys look at that C plus I plus G plus X minus M, a lot of people have also seen where I equals S, right? Someone needs to save for somebody to invest, right? If you want to borrow, somebody needs to have lent the bank the money in the first place for you to be able to take the loan out. This is the biggest problem with cutting interest rates to zero. What is the encouragement for people to save? And if there's no pool of savings, where on earth do people draw capital down to invest from? Net exports, look, on a global case, that's zero, so that's not going to solve the global problem that we face. And obviously, when it comes to government, as I hope I've kind of demonstrably proved, the idea that we need more government to try and have a more prosperous society is demonstrably false. And even when we look at this, is despite the fact that I think they're wrong to focus on it, even when we look at what's actually happening with global GDP, which is the focus and the obsession of sort of mainstream financial people, governments and central bankers, you can see that the trend actually remains very weak. So we had this huge crash during the GFC, bit of a pickup, but basically we've been trending down for the last sort of 3 or 4 years. So despite the fact that rates are at zero, despite the fact that we're printing all this money, despite the fact that governments have been running deficits every single year, we're actually getting less and less out of it each and every time because we're just saturated in debt now. The economy basically won't function and won't grow just by pouring more fuel on the fire. The last thing I want to talk about before I get on to specific investment markets is actually another thing to do with what's going on in the economy, and that's to do with actually what businesses are faced with right now. And these numbers come from Credit Suisse. It was run in February of this year, and it basically looked at reporting season in Australia. So all the top companies reported their financials. And what it showed was that only 22%, I think was the exact number, of companies missed forecasts on dividends. About 35% missed on earnings, but about 50% missed on free cash flow. So what's going on here, guys? Interest rates are at zero. Investors are desperate for yield, right? Older people, older Australians that don't work anymore, they need their share portfolio to pay them some dividends, right? So the last thing you want to do, if you're a company CEO, or if you're the chairman of the board, or if you're on the executive, is cut dividends or not meet the market's expectations of what you're going to pay. Because then people are going to sell your stock because they're going to move to another company that is going to pay dividends. So the one thing that companies tried very, very hard not to do last year, or in the last reporting season, was miss on dividends, right? But free cash flow is the best way of checking out how companies are really going in terms of being able to grow sales and control costs. And half the companies missed because demand is very weak, so sales growth is very poor. And that's a really important thing to keep in mind when we look at corporate health, and it's what this actual comment from Credit Suisse, that you guys at the back in particular won't be able to see this, but this is what they said. They said, we applaud companies attempting to keep shareholders happy, i.e. by paying dividends. However, we hope they're not spreading themselves too thinly. You've got to keep that in mind, right? Because if you pay dividends out, that's cash you no longer have on your balance sheet. That actually is a dent on the overall corporate health of the business because it's money that's not there to be invested in the future or to just be there for a rainy day in case sales fall or there's some other kind of disruption in the economy. And I actually do a bit of consulting to a CFO and a CEO group, and last time I spoke to them, this was a slide I spoke about, and I thought I'd spend a minute on it, and I ended up spending half an hour because it was the one that basically, I guess, started the most conversation amongst them. And what I said, and again, I'm happy to send this to you guys and be interested in your thoughts on it, but what I was basically saying to them is, look, I've got no idea how to run your guys' companies for you, but as far as I can tell, you've got 6 options when it comes to the money that you've got on your balance sheet. And if we look at those options, there's an impact on the potential growth of your business, and there's also an impact on the health of the balance sheet. And broadly speaking, if you were to invest in plant and equipment, in the future, you expect that that's going to be good for growth, right? So our refinery, for example, we're spending money investing in the best equipment on the planet so that we can refine as much bullion as possible in the best and most efficient way, right? Costs money up front though. So theoretically, there is an impact on your balance sheet because that's money that you don't no longer have or you have to borrow in order to do it. But You're doing it because you see future growth. Same thing if you go out and hire a whole heap of staff. If you see, oh, demand is good for our product, or we expect demand to grow, so we'll go and hire our staff. The impact on growth is good. The impact on the balance sheet, at least in the short term, is probably bad because you're actually going and spending more cash. That money's not there anymore. You could just hold on to your money. That's, doesn't really do anything either way. You could pay down debt. And then the last two things you can do is you can pay out higher dividends, or you can buy back your own stock. Those are the two worst things you could do in terms of future growth. And they're also bad for your balance sheet because that's money you no longer have. Overwhelmingly, that is what corporates all around the world are choosing to do right now. They don't want to invest in plant and equipment because there's not very strong sales growth, but they are happy and they feel pressured to pay out higher dividends because that's what investors are demanding. And if you buy back stock, for any of you guys that have done even basic company valuations, will know it's the easiest way in the world of getting earnings per share growth without actually having to sell another product. So those two things, which have overwhelmingly been the focus of corporates and boards across the world over the last few years, are a sure sign that corporate health is actually nowhere near as good as what sky-high earnings or sky-high share prices might otherwise indicate. And ultimately, where's this all leading? It's basically leading to some kind of default of the financial system, and we're going to need to have some kind of, well, we're basically going to change. Like we have many, many times in the past. It's nothing to fear. It's just a particularly volatile experience to go through, and protecting capital through it is pretty important. And look, this quote from Ludwig von Mises, very famous Austrian economist, sums it up pretty well. And he basically said, there's no means of avoiding the final collapse of a boom brought about by a credit expansion, which is what we've been through. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. Basically, pick your poison. Accept you've lived with well beyond your means and contract economic activity enormously, have all the bad debts default and reset. That's what could have happened, but no one, particularly, there's no Western government that will get elected if that's what they run, if that's what they propose to the people. The easiest thing to do is to go down the inflation route and just keep printing money until at some point, unfortunately, the likelihood is we're going to stop accepting the currency that we're paid and pay taxes in and keep in our bank accounts. And that's ultimately the risk. And look, Ludwig von Mises said it. Bill Gross basically is obviously from PIMCO. He wrote a few years ago as well that he basically said there's 4 ways a government can default. And they basically all fit in within that top quote as well. Outright via contractual abrogation. So they could just say, guys, we're not paying you your money back. They could do that. There's nothing to stop them. They've got the guns. They write the rules. But they're not going to do that. What they're going to do is one of the, or a combination of those final 3. They're going to basically try and generate unexpectedly higher inflation. They're going to try and devalue the dollar. And they're basically the 4th one sums it up. Stealthily via policy rates and treasury yields far below historical levels, i.e. your bank accounts will die a slow death because the money or the interest that you earn on them, particularly after you pay tax on them, will be nowhere near enough to compensate the devaluation of the currency. And look, this is not just Jordan Eliseo from ABC saying this. The IMF themselves pretty much said it at the end of last year, where they said much of the Western world will require defaults, a savings tax and higher inflation to clear the way for recovery as debt levels reach a 200-year high. That's the reality of the world that we're all living in and that we're going to have to try and do our best to prosper in the coming years until we do get to the end of this. This is not going to be a permanent state of affairs. They never are. And that's why a lot of people look at this and they think, geez, Jordan, you're a pretty pessimistic guy. And I say, well, actually, I'm not, because I know that what's going to come at the end of this is actually going to be a far fairer, far more transparent system, which will enable us to actually generate much higher levels of prosperity. It's just going to be difficult until we get back to that starting point. So for me, the name of the game for myself, for my family and loved ones and the like, is to try and protect capital and grow it where possible through this period so that I've got it fit to invest when we do get to the end of it and when the dust really has settled. And that basically leads to a look at asset markets and what I'm doing today, I guess, also, and how I see asset markets today. And the first and most important thing to do is actually understand the breakdown of the global asset pool. Now, there's a few different ways you can cut the numbers. McKinsey, JP Morgan, you name it, a few different places have done it, Credit Suisse, to work out what is the global pool of financial assets, how much is it worth? And McKinsey's last report placed it at about $225 trillion of global financial assets floating around, which is a number that's too big for any of us to, doesn't mean anything to any of us. But let's break the number down to a crisp green $100 note and have a look at actually where the money is today. If there was just $100 worth of capital in the world, or financial assets in the world, there'd be basically $52 odd sitting in bonds and debt securities. So that's basically government bonds, corporate bonds, you name it. There's basically $37 sitting in equities or in the stock market. So that's the ASX 200, the NASDAQ, the Dow. There's $10 sitting in cash and alternatives. And there's poor old gold only has $1 in it right now. Very unloved asset class. So that's the breakdown of the global asset pool as it stands right now. So often when I talk to, particularly to older investors, SMSF trustees and the like, I talk about this slide a lot. And I basically say, so what we need to do when we're trying to work out how to position our own capital is think, where is the money now and where is it likely to move to in the coming years? And that is a really, really good way of helping understand, what's an appropriate investment strategy for these times. So let's start with cash. What do we know about cash? Interest rates are at record lows all around the world and likely to stay there for the foreseeable future. In Australia, there's some people that think that interest rates are about to start rising again. I'm absolutely not in that camp. I reckon we'll see lower interest rates over the next few years. We might have a slight pickup first, but we'll see lower interest rates in Australia over the next few years. We'll see higher inflation all around the world. In real terms, cash is losing value, and it's likely to stay like that for a long, long time. So that doesn't mean you shouldn't have any cash in an investment portfolio, but you can no longer just leave all your money in the bank and hope that you can just use compound interest to build your wealth, right? Let's move forward and go to the debt market or the bond market. And this chart goes all the way back to 1871, and it uses the US 10-year Treasury yield. And this is basically the most commonly referenced bond yield in the world. It's basically I guess the flagship US bond yield, and the US Treasury market is obviously the largest bond market in the world, $17 trillion of debt that they're in. And what it shows is yields are inverted. So obviously the higher or the lower the yield, the higher the price. So what has happened over the last 130 odd years? Well, what I'm going to do is talk to you first about what's happened here, because in 1980, bonds were referred to as certificates of confiscation. Basically, what had happened is inflation had got so bad in the late 1970s that even though people were getting higher and higher coupon payments from bonds, nobody wanted to own them because they were thinking, well, this money stream that I'm getting paid, it's just constantly getting devalued through higher inflation. So absolutely nobody wanted to own bonds at that time. Paul Volcker was the head of the Fed. He raised interest rates really, really high, crushed inflation got rid of the inflation problem, and all of a sudden, bonds become an incredible investment. And in fact, from 1980 through to 2011, the annualised return on US government bonds was 6.5% per annum. Imagine the wealth. This is the United States government. At the time, back in 1980, when you could have invested in them, they were the world's biggest creditor. Right? This is the safest balance sheet in the world. And for the last 30 years, you would have been able to get 6.5% compounded. That is an amazing, amazing rate of return. And 30 years is just about long enough for everybody that's been in the financial markets and people like your parents and that who are probably closer to retirement age to think, well, that's how it's always been. Therefore, that's how it will always be. They don't remember that the previous 30 years weren't anything like that. To show you what happened in the preceding 80 years before we hit the biggest bond bull market in history, the return from 1900 to 1980 was just 0.2% per annum. No one made any money investing in the bond market. And if we were to see interest rates or yields normalise, I won't read the quote out in full, but basically investors in bonds will lose between 30 and maybe even up to 50% of their capital, depending what type of bonds they're investing in. So the idea that you can just keep all your money in the bond market and that's a really, really safe way of investing. It was true for the last 30 years. It's really unlikely to be true for the next 30. And you could lose your money either via higher inflation, either via actual contractual abrogation. So you could have some lower quality issuers just say, sorry, we can't pay. So there's a couple of different ways you could lose your money, or you could just see yields normalise and the capital value of your bonds will fall 30% odd if we saw yields normalise. The next one is equities. And this chart goes back to 1880 as well, and this shows the S&P 500, most commonly referenced, or alongside the Dow, the most commonly referenced equity market in America. And what it shows is the cyclically adjusted price-earnings ratio across that time. Now, is everybody familiar with the PE ratio in the room? Yes? Yep. Okay, great. So I won't go through how that's calculated, but basically what you can see is with the PE ratio where it is today, the cyclically adjusted PE ratio is around 25 times earnings now. That's 50% above the long-term average. And as you can see, at a level that it has only reached or exceeded 4 times in history. There are times where it is a no-brainer to put nearly all of your money into stocks. Today is not that day. Because probably the best quote ever when it comes to investing was by a guy called Sir John Templeton, who said the 4 most dangerous words in investing are, this time it's different. So let's have a look at what happened the last 4 times equities were valued like they are today in the subsequent 10 years. Back in 1900, equities were basically like today, 25 times earnings. Over the next 10 years, you went backwards at 0.2% per annum, and at one point you were down just under 40%. The next time was the Great Depression, and if you'd had all your money in stocks for the next 10 years, you would have lost 6.7% annualised, and at one point were down 80%. 1965 was the next one, 24 times earnings, very much like today. You'd have lost 5% per annum over the next 10 years and blown up over 50% of your capital at one point. And the last one was December 1999, which was the all-time high. That was when the NASDAQ was going crazy. Again, if you'd have been in for the next 10 years, you'd have lost 5% annualised and 60% of your capital. Unless this time is different, the next 10 years for broad equity owners, this is not to say there's not going to be good businesses. This is not to say that companies are going to lose 80% of their sales or they're going to have to sack 80% of their staff. That's not the point. The point is that equity ownership is likely to be incredibly unrewarding over the next 10 years. And if history is any guide, it would not be any major surprise to see stocks fall by at least 50% in real terms. I realise I'm kind of pressed for time here, so I'll race through the last bit a little bit faster. So, and look, you can see that this has happened before. You look at what happened from 1929. We live in a market now that's just obsessed with equity bull markets. We think the market owes us 10% per annum. Most fund managers and that you talk to, or if you go and get their literature, they'll only show the stock market from 1980 to now, right? There are periods, and this was one of them, where it takes 25 years for equities to go nowhere, right? 1929 to 1954. We're probably halfway through that period now. From 1999, it's 2014 now, we're 15 years through a period that's probably going to be very similar. And if 10 years from now, investors still haven't made a cent in equities and have suffered another 50 or 60% haircut along the way, they're going to absolutely hate them as an asset class, and that's going to be the best time to buy rather than now when everyone thinks, you know what, you can't go wrong in equities. So I own stocks. I don't not own stocks, but I don't have a massive portion of my wealth in broad equity ownership, and I don't because I just don't think the values are compelling. Come back to why interest rates very quickly won't be allowed to rise. I just spoke earlier, obviously, about how high debt levels are. That's why interest rates basically can't go up, because the sheer volume of money that we owe would make the economy completely grind to a standstill. I won't spend too much time on that. We'll come to gold. Gold's actually really easy to explain, guys. And pretty much I don't even have to talk about it because everything else I've spoken about tonight sells gold. It's the safe haven. You move to it when you do not want to own other stuff. That's the purpose of it. But the really simple way to understand gold, in my opinion, is understanding why it's different to other commodities. And very, very briefly, other commodities like wheat and copper and iron ore, we produce them so that we can consume them, right? Gold is completely different. all the gold that's ever been mined across the course of human history still exists in one form or another essentially today. So the actual annual supply of gold, which is about 2,700 tonnes, that's what we produce around the world, is completely insignificant in the context of the 170 plus thousand tonnes of gold that already exist, that's sitting, I can see you're wearing some, can see in jewellery form, bar form, got a gold ball right there, we go, yeah. You know, that's sitting already around the world. So, go back to Economics 101, guys, what's that a graph of? Demand and supply, right? If the supply of the metal is essentially fixed, and it is because the supply can only grow at about 1% per annum, then prices are purely going to be influenced by demand. Are the current owners of gold more likely to sell it so they can buy something else? Or is there more likely to be non-owners of gold selling a portion of their existing assets to move to bullion? And remember, there's $99 that aren't in gold now for every one that is. So you do not need a lot of money to move from this side to here to see gold prices go much, much higher. That's exactly what I was very, very fortunate enough to be educated on 10 years ago, and we are still right in the middle of that phase right now. And look, don't listen to me about it. Listen again to the team from PIMCO, who wrote a great piece called Demystifying Gold Prices, when they said, when should you own gold? And they basically said, this was how they thought of it. Pretend there was an asset that had no risk of default and a real value that varied over time around some constant level. In other words, the asset has no credit risk and in the long run maintains its purchasing power. Gold's been money and been valuable for 5,000 years, right? How much would investors pay for it? Well, whatever the amount is, it would likely vary over time with the level of real yield available in high quality, nearly default-free assets such as US Treasuries, what they were talking about. So think about it, guys. When the gold bull market died in 1980, you could get 20% just putting your money in a bank account. You could get 18% lending money to the US government, that bond yield chart that I showed you guys earlier. Today, you can't even get the rate of inflation in those places. So back then, it made perfect sense that investors that own gold went, I don't want to own this non-income producing asset anymore when I can go and put my money in a safe term deposit or bank account or lend to the US government and I can get 15, 16% on my money. Now the situation is completely different and much, much more favourable to gold than it is to other asset classes. And I actually ran these numbers myself and basically worked out that since 1971, there's been 29 years, 29 of the 43 years, where real interest rates, i.e. the nominal interest rate minus the rate of inflation, has been 2% or less. Therefore, there's been 14 years where the real rate of interest has been 2% or higher. Just so you understand the average return for gold stocks and bonds in those two environments, this is it. Where real rates are greater than 2%, quite logically, investors sell gold and they're very, very happy owning other assets. So gold has, on average, dropped 4%. Other assets have done absolutely brilliantly. But in environments like the one we're in today and that we are going to be stuck in for the foreseeable future, gold prices have gone up by, on average, not every year, last year they fell, but on average, 19% per annum, which is far, far higher than what stocks and bonds have returned in lower real interest rate environments. And those factors, alongside the rise of China, I won't touch on this. Those factors, alongside the rise of China, are why I'm still so bullish on gold. And that's why I have this thing on follow the gold in terms of the US, Switzerland, and China, because basically what happened last year was that physical gold demand in China absolutely exploded. They net imported, well over 1,100 tonnes of bullion. And what basically happened, for those of you that have a passion for the gold space, is the majority of the world's gold refineries are actually in Switzerland. So what you saw was this huge divestment of gold from Western investors through ETFs and the like. That gold got sent to Switzerland where it was re-refined into 1 kilo gold bars. Then a lot of it went to Hong Kong, and from there it disappeared up into China, where in all likelihood we will not see it for at least a couple of generations, because they are desperately trying to build their gold reserves. Not just the government, but everyday citizens in China as well are buying gold as fast as they can get their hands on it. And just in terms of a few statistics and understanding the potential for gold demand, The USA, even today, despite claiming that gold is not money and hasn't been money for 40 years, still keep 70% of their foreign exchange reserves in physical bullion. It's an incredible allocation to a supposedly dead asset. China, with 1,054 tonnes officially, only owns about 2% of their reserves in physical gold. Now, check the photo and spot the odd one out. Every single major economy or empire or most powerful nation on earth that's ever been basically gotten to the top has done it by having, by far, the world's largest accumulation of physical gold. But go all the way back to Roman times, Byzantium, Florence, the Netherlands, you name it. Gold, 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 paper. You don't have to be an economist, guys. You just need to be a very, very amateur historian to know what we're basically in the cycle of happening. China will be the largest economy in the world in the next several years. Doesn't mean the US is going to become a backwater or anything like that, but there has never been a power that has grown to the kind of influence that China wants to and will no doubt get to without acquiring an absolutely enormous quantity of physical gold as a strategic reserve asset. They're going to keep buying it at the state level, at individual level, as will India as well. And that, alongside the portfolio reallocations that I was talking about before with the $99 and the $1, are why I'm still bullish on gold and why it's still the largest asset in my portfolio, even though it is volatile along the time. Last one, and this is very, very relevant, so I'm going to spend 5 minutes on this, is talking about superannuation. There's Ross Greenwood from Money Minute. I don't know if any of you guys watch that on the Today Show and stuff like that, but just a quick question for you guys. Anywhere in life, do you think you'll get ahead by just following the crowd and doing what everyone else does? Anyone? No? Okay. Right. Well, that's in that sense, yes. But in whatever profession you choose to specialise in, whatever it is, you know you're going to have to do something different to do better than the rest, basically. Doesn't matter what it is, sports person, you name it. Doesn't matter what you want to do. With that in mind, whatever you do, please don't ignore your superannuation from the day you start working, because as Ross basically says, all the super funds do is follow indexes. That's what they're paid to do. Doesn't mean they're bad people, doesn't mean they're trying to do the wrong thing with your money, but they're not managing it on your behalf with your specific interests at heart. They can't. It's too big a system for them to specialise on your behalf. So you need to understand what's going on with your money, and you need to make sure you're comfortable with the choices that are being made on your behalf, or you need to start making choices on your own behalf. And to give you a sense of scale, this is as good an analysis for you guys as any. I know none of you are 35 right now, but that's how old I am. You will retire at 65, 70. You'll be putting money into the system for longer than I will. And I did this analysis a few weeks ago over in Perth, where I was talking to people who are a little bit older than you guys, so forgive me that the example is not perfectly appropriate. But basically what I showed them was the advantage of taking control of super through a self-managed super fund. And look, a self-managed super fund will not be appropriate for you guys straight away, that is for sure, but I still think this is an interesting piece to keep in mind. And basically what I said was, assume you've got two options. You can either stay in a traditional fund, or you can move to an SMSF. And let's assume you're 35 years old and you're going to retire at 65. And let's assume by this point that you're 35, you're married, and between you and your spouse, you're earning $150,000 combined, which is basically 2 times the average wage in Australia, full-time wage, plus a little bit on top because the average wage is just a bit over $70,000 now. And let's assume that between the two of you, you've got $100,000 in super by the time you get to 35. I guarantee you guys will have something like that. The amount of people that are in their 30s that have got very big super balances already because they've been paying in for 10 years, they don't even know where the money is. It's amazing. Let's also assume, and you are going to have to do it, contribute 12% of salary every year across your working life, and assume that your salary grows by 2% per annum. Let's hope that you can get at least that kind of wage growth. Over the course of your life, from 35 to 65, you'd put in nearly $1 million into super. That's how much money you're going to put in. It's a big asset, guys. Then assume your returns compound at 5%. Now the question is, what structure do you run your superannuation under? You could stay in the sort of traditional retail fund model. No setup costs with that kind of thing. That's free. You know, a lot of people that go and set up a self-managed super fund might pay a couple of grand to do that. Annual administration, There's no specific bill that you get for that if you're in a retail fund. You never get a bill from a retail fund, ever, right? So zero there. You might pay $1,250 per annum fixed through by having an SMSF. But this is where it gets interesting. The average fee per annum for a retail fund in Australia is about 1.75%. You could run exactly, or as good as, exactly the same investment strategy that they're doing. In fact, you could be more flexible for yourself than what they're doing. For about 1/15 of that cost, 12 basis points is basically what you could do that for. Over the course of that life, over the course of the 30 years, in terms of understanding the difference in fees that you would pay, the SMSF for you and your spouse would cost about $85,000. Does anyone want to guess what you guys think you might pay in superannuation fees across your working life? 200? $500,000? Anyone? Any other guesses? There's no prizes, just guess. No? Okay, let's go with that. You basically, if you split the two of it, you're basically spot on. $321,000 in fees for no service, no phone calls, no personalised portfolio, nothing. Just you're forced to consume the product, and that's what you're paying fees across your working life. So if there's one thing I can encourage you guys to do, as I say, please don't go set up an SMSF right now, but engage in your super from the day you start working, right? The day you start working, you're going to have to put money in, pay attention to it early. Most people will find it really hard to save 12% of their money outside of super when you're paying for all your day-to-day expenses. You know, you get married, you have kids, you get a mortgage. So that's a big pool of cash for you to keep in mind. It does have tax advantages as well. As I say, the last thing you want to do is basically let it go in fees without knowing where the money's going. I guess just a final thought for you guys, and this probably sums up my view of the world, and I guess the dangers that we face in the short term, and that is that, you know, as Ayn Rand said, you can ignore reality, but you cannot ignore the consequences of ignoring reality. That's basically what's happening. Governments around the world are not dealing with the reality, and they're trying to pretend and pull the wool over everyone's eyes that everything's just going to be fine with printed money and with perpetual debt and perpetual deficits. It's never worked in history. Common sense tells you it doesn't work. So prepare for the fact that things are going to be a little bit troublesome in the next sort of 10 years. But more importantly, stay optimistic that they will also get better, and that's the thing to really be excited about. So basically, takeaways, I guess, are probably just what I said there about the social welfare state is dying, that change will be coming, hopefully early in your working lives. So stay nimble, stay educated, read as much as you can, and try and seize the opportunity through this. I actually look at all this and I'm excited with what I do day to day. As much as it's troubling at a macro picture, for me with my life, I actually see incredible opportunity in what's going on and what's coming in the next few years. And there's no point panicking about a big picture you can't control when you can maximise what's going on in your own life. Basically work hard and work smart. For any of you, Ray's been brilliant to come in and do some work with us at ABC Bullion. We've been delighted to have him in. Most importantly, as far as I can tell, or in my opinion, the minute you can start working, the better it is for you guys. Study's really, really important, and you should try and get the best grades and do fantastically well at university. But the minute you can start working, do it, you'll get contacts, you'll start earning income, you'll develop good habits. Don't hesitate. I started work when I was 17. I started working in finance. Whilst I studied, it was a decision that put me 5 years ahead of all of my colleagues by the time we'd all finished university, and it was no doubt hugely important. Those NASDAQ stories and that, I wouldn't be able to tell them if I wasn't actually already working. Leverage your networks as much as you can. You know, there's an old saying, it's not what you know, it's who you know. Some very smart people work that saying out. It's true. If you've got good contacts, don't be afraid to use them. Again, I'll come back to myself. My first job, my dad got me the interview because he knew one of the people involved there. You know, that was 20 years ago now. Maybe I would never have got that job if it wasn't for my dad knowing someone. If you have a network, if you can use it in the right way and always give back, don't just take, because people will figure you out pretty quickly if you do. Don't be afraid to leverage your networks, and obviously look after your money as well, because alongside your health and your education, it does give you choices. I know you're all probably pretty sick of me by now, but if you want to follow some of the research that we put out at ABC, or are interested in some of these thoughts, and you're on Twitter, you can follow my handle. You've got my email address there. As I say, I'll give this presentation to Michael. Feel free to jump onto our Investor Centre as well and sign up. It's completely free. We offer a lot of information on the markets and super and investing and all that. It's all perfectly welcome for you guys. I'd love you to join up and subscribe if you find it interesting. And last but by no means least, we have a great relationship with a company called First Gold, who actually set up what I think is one of the neatest gold solutions in Australia, where you can basically set up with your bank account the option to regularly save in physical bullion. So you might say, okay, I want to save 20 bucks a week in gold, and you basically set up a direct debit with your account and you can buy bullion that way. Really, really fantastic way to get in good savings habits and save in physical gold, which is a scarce resource, rather than in paper dollars, which can and are being printed out of fashion. So guys, thank you very much for your time. I appreciate I ran over time, but